Hello, Paul Long here, and thank you again for watching another episode of How to Buy a Business Using an SBA Loan. And in this video, we're going to talk about underwriting, cash flow, and credit. I definitely expect this video to get quite a few views because this is really what goes into the deep credit part of what I'm looking for as a lender when looking at a credit. So let's dive into this. Let's talk about cash flow. Cash flow is critical to any business. If you don't have sufficient cash flow, you got problems, okay? So we want stable cash flow from the purchasing business. Now, if I was to buy a business, I would definitely want to make sure that business is making money, because why would I want to buy something that's losing money? So are the income trends increasing? Are you seeing profitability increase? Now, there's many situations where you'll find that maybe the owner is getting ready to retire. Maybe there's health issues. Those are usually the main reasons why people sell a business. So it's important to understand, okay, sales have been decreasing a little bit. Is that because they haven't been focusing on the business? Or is it because of COVID? Is it because, what is the reasoning behind that? If it's a logical reason and you know that you can turn that around and you can prove that, no problem. That's what we're going to want to understand. Now, we're going to use in some examples here in this video, what is EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. And I'm going to show you how we calculate that and why that's important to you. Another word that we look at as a part of EBITDA is also known as seller's discretionary earnings. And that is when you take out the previous owner's personal expenses, which should never be in your business, but God knows they're always there. We want to add those back to the cash flow, and we do that in the form of EBITDA. And what we're looking for is a debt service coverage ratio. How much do you have in one hand of debt versus the other in income? And you divide those two together, do you have a ratio of 1.2 to 1.25 or better? Some institutions and SBA say 1.15. I'm going to use in this explanation 1.25 or better. So let's look about how we talk about cash flow. So let's say, for example, you have gross sales at $750,000. You have your expenses at $400,000. Then we're going to add back depreciation because you did not write a check for depreciation. That's a tax credit. So that gets added back to your revenue. You're going to add amortization, which is the same type of thing as depreciation, but it's amortization. I can never say it. See, I'm just like my customers. I can't say it. Amortization, we're going to add that back. We're going to add any sort of seller's expenses. Maybe he or she was paying for a vehicle that is not going to be a part of the business when you purchase it. We're going to add that back. We're going to add back the seller's W-2 wages. Okay, so there's several ways that you can actually take money from a business, whether it's W-2 wages or it's through distributions of the company. We're not going to add back distributions, and you'll see why here in a minute, but we are going to add back the seller's W-2 wage. And then we're going to find out what is the new new buyer. Sorry, I have new seller on there. What are they going to want to take from the company? Okay, so let's say, for example, the seller was taking out $75,000 and the new buyer wants to take out $100,000. That's fine, but we want to make sure that cash flows. So we're going to turn that, and your EBITDA or seller's discretionary earnings is $381,500. Okay. Now we're going to look at the debt side. So that's the income side. We're going to look at the debt side. The debt side is, okay, so what exactly are we going to do? We have a new loan. It's a $500,000 SBA loan at 8% for 10 years, which comes out to $6,066 a month, or you times that number by 12 is $72,796 a year. Okay. So now we're going to do our debt service coverage ratio. So in one hand, the income, we have $281,500. In the other hand, we have the debt of 72,796. And so we need to make sure that the business earns at least $1.25 for every dollar of loan payments that it has. So if that's the case, if I'd use the math, this comes out at 5.24%. So again, we're looking for 1.15 to 1.25, 1.3, somewhere in there. So it's substantially above that. So that means that there's revenue in there, and that's a very, very good sign. So that's how we do kind of a back of the napkin look to make sure that there is money available to service the new debt. Again, if this number is below 1.25, or even if it's 1.00%, which means your income can match the loan payment one time. There's no cushion. And anything less than one means it just doesn't cash flow, and that you're probably going to possibly using personal money to make the payment, and we don't want to see that. So the next thing we want to talk about is credit. What kind of credit expectations do most institutions need out there? I'm going to say for this discussion, 680 is a minimum credit score. A 680 in my book, there's something in your credit. Maybe there's a couple late payments. Maybe you have some high credit card debt. There's a reason why you have a 680. But I would say that that's a 680 is a reasonable minimum for an SBA loan. SBA technically does not have a minimum credit score, but as a person who's been in the industry for 25 years, lenders have certain expectations, and 680 is a good average. Divorce. Now keep in mind, a divorce is not a reason for bad credit. People go through divorce and can still have good credit. It's what happens during the divorce that is usually the issue on credit. So if there is a divorce, we're going to want to know about it. We're going to want to understand this story. Do you have any sort of judgments against you? Do you have any bankruptcies? Bankruptcies are the death of a deal, okay? If you had a discharged bankruptcy, I would say in the last 5 years, the chances of you getting the loan are pretty thin, okay? If you've had a bankruptcy that was discharged greater than 5 years, and you have a good story on why it happened, then it's going to be something that we will definitely look at. I have had people come in who filed bankruptcy less than a year ago wanting to buy a business. No one's going to do that deal, unfortunately. It's too soon. Hopefully this helps you a little bit from the underwriting and credit standpoint of an SBA loan. Make sure to check out my other videos at paultlong.com when it comes to the business acquisition series. And also I have another video series on how to buy commercial real estate as well. Thanks so much for watching, and see you on the next video.